Hi everyone, and welcome to Swinburne Online. I thought I would just do a quick presentation on accruals and deferrals because this tends to be a topic that a lot of people have confusion over. So I thought I would try to address it before you get to that confusion point. Okay, so accruals and deferrals. Accrual accounting recognises income and expenses when they are probable and can be reliably measured, not when the cash is received or paid. When we look at accruals, we also need to think about deferrals or prepayments. There are two types of accruals: accrued expenses and accrued revenue. Accrued expenses are recognising expenses incurred but not yet paid in cash. In most cases, you already received the goods or services, but have not yet settled the liability. Accrued revenue is recognising services performed or goods delivered, but not yet received in cash. We record this as an adjusting entry as the income had been earned even though it had not been paid. If we look at deferrals or prepayments, there are also two types of deferrals: prepaid expenses and unearned revenue. Prepaid expenses are expenses paid in cash but before they are used or consumed in the period in question. For example, if we pay 2 months' rent for this month and one for the next, then the rent for next month is considered prepaid. Unearned revenue is also known as income received in advance. It relates to cash received before services are performed, like in the case of coaching fees received for 3 months with 2 months in advance. This is an example of accrued expense. Mary's Wholesale Flowers receives its electricity account from ABC Power every 3 months. The last account of $6,600 was for the period 1st of February to the 30th of April and was received on the 15th of May. The next bill is not due until August, but we need to include an estimation of electricity usage for May and June when we complete the accounts to 30th of June. Electricity consumed during May and June must be recognised as an expense for the year ending 30th of June, so we use the previous bill to estimate this expense. So, taking $6,300 dividing it by the 3 months gives us $2,200 per month on average. An amount of $4,400 is calculated for the 2 months. This is shown as an expense in the profit and loss of $4,400 for May and June, and as an accrued electricity expense of $4,400 in the balance sheet as a liability. When the account comes in and is paid later in August, we reverse the accrual in the balance sheet and reduce the asset bank by the amount that is paid. Any difference will be in the current month's expense. So this is an example of accrued income. Charlie Stores has $100,000 in the bank. Interest on the investment is paid quarterly, with the April to June instalment due to be paid on the 26th of July. The interest is deemed to be income applicable for the period ending 30th of June as it was earned in that period. The interest is $3,000 for the quarter April to June. An accrual is raised to show the income in the profit and loss of $3,000 for interest earned and an asset, accrued income, in the balance sheet. When the interest is received, the asset, cash at bank, will be increased by $3,000 and the asset, accrued income, will be reduced by $3,000. The profit and loss is not affected because the income has already been captured in the correct period that it relates to. This is an example of a prepaid expense. Insurance. A company pays $1,200 for insurance in a year, so being $100 per month. This is paid in December 14 for the following year, Jan to December 15. The entry in December 14 is an increase in asset of prepaid insurance and a decrease in asset, cash of $1,200 in the balance sheet. In June 15, we need to make sure that the correct expense is showing the accounts for the 6 months Jan to June 15. In June 15, the profit and loss should be showing an insurance expense of $600 for the insurance from Jan to June, so 6 times 100. The balance sheet will have a balance of $600 left for prepaid insurance to be expenses each month for the rest of the year, so from July through to December 15. Please note, though, Depreciation is a form of prepaid expense. An item is purchased and then expensed over its effective life. So, unearned revenue. A customer pays $1,000 for a service in June that will not be provided until July. In the accounts in June, we have received the cash, but have not yet earned it. We need to show this as an increase in the asset, cash, on the balance sheet of $1,000 and an increase in the liability, unearned revenue, of $1,000 in June. When the service is completed in July, the $1,000 is shown in the profit and loss as sales, resulting in an increase in retained earnings, and the liability unearned revenue is reduced by $1,000. The major advantage of accrual accounting is that it matches revenue and expense items to the period in which they have occurred, providing a much more accurate picture of profitability. It also gives an indication of the level of bad and doubtful debts incurred. The disadvantage of this form of accounting is that it does not give us any indication of the cash flow of the company. As always, if anything is unclear, please ask me, either through message or on the discussion board where we can openly discuss it. I hope you found this interesting and helpful in identifying and breaking down the accruals and prepayments and deferrals, and I look forward to talking to you soon. Thanks a lot, everyone. Bye-bye.